Um, the perception that people in the 1980s could afford homes despite much higher interest rates than today, when current buyers express affordability struggles, stems from fundamentally different economic and housing market realities between the two eras. This apparent paradox requires a deeper comparative analysis. The 1980s were indeed marked by exceptionally high mortgage rates, peaking near 19% in 1981 as the Federal Reserve battled rampant inflation. However, several critical factors mitigated this impact. Firstly, home prices were dramatically lower relative to household income. In 1980, the national median home value was around $47,200 when compared to the median family income of around $21,020 in the same year. The national house price to income ratio was approximately 2.5. This meant a median home cost roughly 2.5 years of median household income. This fundamental affordability meant the principal amount financed was substantially smaller relative to earnings, making homeownership more manageable despite high borrowing costs. Uh, Secondly, the dynamics of inflation and wage growth played a pivotal role. The aggressive rate hikes aimed to tame the great inflation. While real inflation adjusted wages saw fluctuations, the expectation of future nominal wage growth and general inflationary trends meant that a homeowner's income was widely perceived to be growing. This provided a mechanism to grow into a mortgage payment over time, even if initial payments felt burdensome. Real inflation adjusted house prices also declined by 13 to 17% from peak to trough during the 1980s, further making homes relatively more affordable over time. Thirdly, the lending landscape and down payment norms were different. Buyers generally provided substantial down payments, often 20% or more. This meant those entering the market had significant savings, reducing the loan amount subject to high interest rates. Additionally, housing supply did not face the same chronic undersupply issues seen in recent decades. Fast forward to the 2020s, and mortgage rates have been considerably lower, around 6 to 8%. Yet, affordability remains a pervasive and intensifying challenge. The primary reason is skyrocketing home prices that have far outpaced wage growth. The national median home sale price has soared well over $400,000, pushing the house price to income ratio to nearly 4.4. This means it now takes almost twice as many years of median income to afford a median priced home compared to the 1980s. Even with lower interest rates, the sheer magnitude of the mortgage principal translates into historically burdensome monthly payments. Compounding this is a severe and prolonged housing supply shortage. Following the 2008 financial crisis, new housing construction plummeted and has consistently failed to keep pace with demand. This chronic scarcity creates relentless upward pressure on prices, regardless of interest rate fluctuations. Finally, contemporary demographic and financial shifts create additional headwinds. Today's first time homebuyers often face significant student loan debt. Nearly a quarter of all recent homebuyers and 37% of first time buyers carry student loan debt, which impacts their ability to save for down payments and can raise their debt to income ratios, making mortgage qualification more difficult. In conclusion, the 1980s featured high rates on fundamentally more affordable homes with different economic expectations. Today's market presents lower rates applied to vastly more expensive homes, exacerbated by a critical supply deficit and heavier consumer debt, creating a more profound and widespread affordability challenge for many aspiring homeowners.